At its highest point, China controlled around $1.2 trillion in United States Treasury bonds. Today, that figure has declined to $682 billion, the weakest level recorded since September 2008. The reduction equals 43%. Over the course of a decade, Beijing steadily and quietly unloaded large amounts of American debt in a calculated long-term strategy. In March 2026 alone, foreign official ownership of United States government debt fell by $127 billion. That became the biggest single-month foreign liquidation since the pandemic crisis of 2020. At the same time, Chinese gold reserves climbed to 2,921.3 metric tons after 18 straight months of purchases through March 2026. Beijing has been systematically exchanging United States treasuries for gold reserves. This is not a simple portfolio rebalance. It is a structured, deliberate, multi-year effort aimed at reducing dependence on the American financial structure. And the pace is increasing at the exact moment the United States requires more debt buyers, not fewer. The roots of this situation go back to 1944. During the Bretton Woods Conference after World War II, the United States dollar became the primary reserve currency of the global system. Other currencies were tied to the dollar, while the dollar itself remained linked to gold at $35 per ounce. Countries accumulated dollars because those dollars effectively represented gold itself. Then, in 1971, President Richard Nixon ended dollar convertibility into gold. The direct connection between the dollar and precious metal disappeared. Even after that decision, the dollar continued to dominate global reserves. The reason was no longer gold backing. The system survived through confidence, institutional history, military strength, and the enormous depth of American financial markets. That arrangement delivered a powerful advantage to the United States. America could borrow from the rest of the world in its own currency without facing exchange rate exposure or the fiscal limitations imposed on many other nations. In 1965, former French President Charles de Gaulle described this position as America's exorbitant privilege. At the time, the phrase carried weight. Today, that privilege faces the most organized and sustained challenge in its history. China's strategy follows several clearly defined steps. The first move involves cutting Treasury exposure. Chinese holdings of United States debt declined from $1.3 trillion to $682 billion over recent years. That means $618 billion in American government debt no longer sits inside Chinese reserves. Every dollar removed from Chinese ownership must now be purchased by another investor. Higher yields become necessary to attract replacement buyers. That pressure feeds directly into the 30-year Treasury yield, which climbed to 5.089%, while mortgage rates moved above 7%. The second step centers on aggressive gold accumulation. The People's Bank of China purchased gold continuously for 18 months through March 2026. Gold represented roughly 4% of Chinese foreign exchange reserves in 2022. By early 2026, the share reached 10%. In only 4 years, the gold portion of China's reserves more than doubled. During 2023, the People's Bank of China became the largest central bank gold purchaser in the world, adding 225 metric tons during that year alone. One major banking institution estimated that China's actual gold stockpile could be nearly twice the official number. According to that estimate, Beijing routes part of its acquisitions through offshore custodians that remain absent from public reserve data. If those projections are correct, China's real gold holdings may already exceed 4,600 metric tons. That would narrow the distance with the United States, which officially holds 8,330 metric tons, far more rapidly than public data suggests. The third phase focuses on constructing an alternative financial infrastructure. China's cross-border interbank payment system, known as CIPS, operates as a direct substitute for the Western-controlled SWIFT network. CIPS handles yuan-denominated international transactions outside traditional United States financial channels. By 2026, the system expanded across 185 countries. Every payment completed through CIPS represents a transaction that bypasses the dollar. Every barrel of oil purchased in yuan removes the need for dollar conversion. Saudi Arabia, long considered a central pillar of the petrodollar structure, started accepting yuan for Chinese oil transactions during 2023. That move represented a major fracture inside the framework supporting dollar dominance since 1974. The fourth stage involves building a gold-linked settlement alternative through BRICS. The BRICS bloc, including Brazil, Russia, India, China, South Africa, and newer members, has been testing a prototype settlement instrument called the unit. The structure is composed of 40% gold backing and 60% member currencies. Testing has taken place on the Enbridge cross-border payment platform. Combined, BRICS nations now possess more than 6,000 metric tons of gold reserves. That equals 17.4% of total central bank gold reserves worldwide, compared to 11.2% in 2019. The The increase occurred over 7 years. In March 2026, Xi Jinping published a speech in Xuxi, the official journal of the Chinese Communist Party. The statement called for expanding the yuan into a currency widely used in international trade and foreign exchange markets, with the standing of a global reserve currency. That was not an offhand remark. It was a formal declaration of strategic intent published in one of China's most authoritative policy outlets. The dollar once represented 71% of global foreign exchange reserves in 1999. Today, that share has slipped to roughly 57%, the lowest level seen since 1994. A World Gold Council survey conducted in 2025 revealed that 73% of central bankers worldwide expect the dollar's reserve share to continue declining. These are not television analysts, journalists, or political voices. They are the officials directly responsible for managing sovereign reserve assets. Nearly 3/4 of them believe the dollar's global influence will weaken further over time. Then came the event that accelerated China's strategy more than any other development. In February 2022, after Russia launched its invasion of Ukraine, the United States, together with allied nations, froze approximately $300 billion belonging to the Russian central bank. The action happened immediately and without advance notice. One executive order effectively immobilized the reserve savings of an entire country. Beijing observed that decision carefully and reached a direct conclusion. Any nation storing reserves inside dollar-based assets remains vulnerable to American financial pressure. Any country exposed to sanctions risks having its reserves frozen. Gold operates differently. Gold cannot be frozen in the same manner. Gold stored domestically cannot be confiscated by a foreign state. Gold also exists outside American financial systems. For the People's Bank of China, gold became a lower-risk reserve asset precisely because it sits beyond the reach of United States sanctions mechanisms. That realization, triggered by the Russian reserve freeze, became the central catalyst behind China's 18-month uninterrupted gold purchasing streak. The freeze imposed on Russia served as a warning shot. China reacted more strongly than almost anyone else. Since 2022, the response has remained disciplined, patient, and increasingly aggressive with each passing quarter. Now the consequences move from geopolitics directly into personal finance. Reserve currency status gives the United States one extraordinary capability. America can sustain long-term trade deficits without suffering an immediate currency collapse. Most countries cannot do that. And when nations spend more on imports than they earn through trade, currency pressure eventually arrives. Their currencies weaken. Imported goods become more expensive. Inflation accelerates. Borrowing costs rise sharply. For decades, the United States avoided that cycle because foreign governments needed dollars for international commerce. That requirement created constant structural demand for dollars, regardless of American borrowing levels or federal spending growth. That built-in demand is now weakening. The dollar's reserve share has fallen to 57%, the weakest level since 1994. As that percentage declines further, structural demand for dollars declines alongside it. When global demand for dollars weakens, the United States loses the ability to borrow at lower costs. The federal government must borrow $2 trillion during fiscal year 2026. At the same time, China continues reducing Treasury exposure. Japan has been selling assets to support the yen. Foreign official holdings of United States debt dropped $127 billion in a single month during March 2026. That raises the critical question: who purchases the required $2 trillion in debt? The answer becomes domestic investors, hedge funds, pension funds, mutual funds, and ordinary Americans. All of them require sufficient yield compensation before committing capital. That is why the 30-year Treasury yield climbed to 5.089%. It is also why mortgage rates remain above 7%. De-dollarization is no longer a distant possibility. It is already affecting bond yields that shape mortgage costs across America today. Attention now shifts to the M-Bridge platform, to the infrastructure China is constructing to bypass American financial influence permanently. M-Bridge is a cross-border payment network jointly developed by the central banks of China, Hong Kong, the United Arab Emirates, and Thailand. The platform uses central bank digital currency technology, known as CBDCs, to settle international transactions in real time. The system operates without correspondent banking, without SWIFT, and without relying on United States financial infrastructure. In November 2024, M-Bridge reached minimum viable product status. Then, in 2025, Saudi Arabia joined as a full participant. Saudi Arabia has served as a cornerstone of the petrodollar system since 1974. The kingdom's agreement to price oil exclusively in dollars helped anchor the dollar's reserve currency role after the Bretton Woods era ended. Now Saudi Arabia participates in a platform specifically designed to process transactions outside the dollar system entirely. That is not a minor diplomatic adjustment. It is a structural challenge to the foundations supporting dollar dominance. The gold market reflects these developments directly. Gold prices moved above $3,200 per ounce during early 2026. China's central bank, after 18 consecutive months of purchases, became responsible for roughly 25% of yearly inflows into the global gold market. When a single buyer absorbs 1/4 of annual market supply, prices develop a structural floor underneath them. JPMorgan Chase projects gold moving toward $4,000 per ounce by the middle of 2026. That projection rests on continuing central bank purchases led by China, combined with de-dollarization-driven buying from emerging market central banks. The same 2025 World Gold Council survey showed that 73% of central bankers expect to expand their gold holdings over the next 5 years. This is not speculative momentum. It is institutional demand supported by long-term reserve commitments extending across a 5-year horizon. Another warning emerged publicly in early 2025 from United States Treasury Secretary Scott Bessent. He stated that China could be developing digital assets backed by something other than the yuan itself, potentially a gold-backed digital yuan. Consider the effect on global currency markets if China publicly revealed its actual gold reserves, which some analysts estimate exceed 4,600 metric tons. Imagine Beijing introducing a gold convertibility mechanism tied to international yuan settlements and positioning the yuan as the only major currency supported by hard assets. Such a development would become the largest monetary event since President Richard Nixon ended the gold standard in 1971. Attention now turns to BRICS because the coalition advancing this transition is larger than many Americans realize. In 2024, BRICS expanded to include Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. The enlarged BRICS bloc now accounts for approximately 35% of global GDP, exceeding the G7. Combined gold reserves among BRICS members surpass 6,000 metric tons. That equals 17.4% of all central bank gold reserves worldwide, compared with 11.2% in 2019. The BRICS New Development Bank has already distributed more than $30 billion in development financing using non-dollar currencies. Its prototype settlement mechanism, composed of 40% gold backing and 60% member currencies, continues active testing through the mBridge platform. This is no longer a theoretical substitute for the dollar system. It is functioning infrastructure being assembled in real time. Another number defines the broader strategic landscape. The United States holds 8,333 metric tons of gold stored at Fort Knox and the Federal Reserve Bank of New York. China officially reports holdings of 2,313 metric tons. However, ANZ Bank estimates the real figure may be nearly double, above 4,600 metric tons. If that estimate proves accurate, China already ranks as the second largest gold holder in the world. The gap separating China from the United States would also be shrinking much faster than official numbers indicate. At the same time, Beijing continues lowering exposure to United States Treasury securities while replacing dollar-based paper assets with physical gold beyond the reach of American sanctions. This has become one of the most disciplined long-term financial strategies executed by any government in modern history. The implications then move directly into investment behavior. Gold ownership becomes a strategic allocation rather than speculation or short-term trading. When 73% of central bankers globally are increasing gold reserves, and China alone represents 25% of annual inflows into the gold market, the structural floor beneath gold prices becomes both visible and durable. An allocation between 5% and 10% in physical gold or gold-backed financial instruments inside a diversified portfolio provides protection against dollar erosion tied to de-dollarization. Long-duration fixed income exposure denominated in dollars also faces pressure. As reserve demand for dollars declines, yields on long-term United States treasuries rise accordingly. Bond funds holding 20-year and 30-year treasury securities lose value in that environment. Shorter duration instruments, such as treasury bills, 6-month CDs, and money market funds, provide insulation from that repricing process. Technology and industrial investments connected to domestic supply chain reshoring also receive structural support. The CHIPS Act, the Pentagon's Mine Magnet Investment Initiative, and the One Big Beautiful Bill's critical minerals allocation all direct capital toward domestic industrial expansion. Companies building that infrastructure benefit from a long-term policy tailwind extending across multiple years. The dollar index also deserves close attention. The United States dollar index, known as DXY, has already fallen more than 15% since 2022. If the dollar's reserve share declines from 57% toward 50%, the DXY moves lower again. Every American holding savings or cash accounts denominated in dollars absorbs that decline through reduced real purchasing power. Dollar weakness is not a future possibility. The process is already underway. The expansion milestones of mBridge and CIPS also matter. Every additional country entering M-Bridge adds another participant routing international trade outside the dollar framework. Saudi Arabia represented the most significant milestone so far. If another major oil producer, such as Iraq, the United Arab Emirates, or Russia, announces full yuan oil pricing together with M-Bridge settlement participation, the petrodollar structure faces a genuine structural rupture. Such an event would become the largest dollar shock since 1971. Unlike 1971, however, the United States would confront that moment carrying $39 trillion in debt, a reserve share of 57%, and no gold convertibility mechanism to reinforce confidence. The broader picture now becomes clear. China reduced Treasury holdings by 43%, moving from $1.2 trillion down to $682 billion. The country purchased gold for 18 consecutive months and officially accumulated 2,313 metric tons, with actual holdings potentially much larger. It established CIPS as a dollar-independent international payment network spanning 185 countries. It joined M-Bridge, which now includes Saudi Arabia as a real-time cross-border settlement platform linked to gold-based trade infrastructure. President Xi Jinping publicly called for reserve currency status for the yuan, while the dollar's share of global reserves dropped from 71% to 57%, the weakest level since 1994. These are documented policies, measurable statistics, and operational financial systems, all moving in the same direction. If this report helped clarify what China is doing with the dollar system and how those developments connect to global finance, stay tuned for the next analysis covering what a reserve currency transition could mean for American savings, mortgages, and retirement assets in the years ahead. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.